What if just a few dates on the calendar could decide the direction of the entire silver market? What if the real battle is not about headlines, but about contracts, delivery rules, and who is forced to act first? The final week of February and the first days of March could become extremely important for silver traders, investors, and especially for those holding futures contracts. This is not just routine expiry activity. This is where pressure can quietly build inside the system. Welcome to Gold Silver Scope. Let's break this down in a clear and simple way. The first important date is February 26th, known as the first position date. This is the final day for traders who are long March silver contracts, but do not want physical delivery. If they do not close or roll over their contracts by this date, they must be financially and operationally ready to accept physical silver. This is where things start to get serious. After this date, clearing firms expect that any remaining long position belongs to someone who actually has the money and infrastructure to receive 5,000-ounce silver bars per contract. Speculators and funds that only wanted price exposure, not physical metal, must exit. If they stay, they risk being assigned delivery. The next key date is February 27th, known as the first notice day. This is when the dynamic changes completely. From this day forward, short sellers, not the longs, control the timing of delivery. A short can notify the exchange that they intend to deliver physical silver. Once that notice is issued, it is assigned to a long holder. The long has no control over the timing. They cannot request delivery early. They cannot delay it. And once assigned, they cannot exit the contract. They must accept and pay for the metal. This is extremely important. If a long remains open after February 26th and into February 27, they are effectively saying, "I am ready to take delivery." And if a short decides to issue a notice, the long must be prepared to pay in full. Delivery usually completes the business day after notice is given. Then we move to March 2nd, the first delivery day. This is the earliest date that physical silver can officially change ownership. What actually happens is not trucks moving immediately. Instead, a vault warrant representing 5,000 ounces of silver in a CME-approved warehouse is transferred from the short to the long. The long pays the full invoice amount based on the settlement price. Delivery can continue on any business day until the end of March, but the timing is always determined by the short issuing the notice. From February 27 onward, any long still in the market is at the mercy of the short's timing decisions. However, the bigger question is not timing. The bigger question is supply. At the moment, the number of open contracts is dramatically higher than the amount of registered silver available for delivery. There are nearly 3 times as many ounces represented by open contracts as there are ounces sitting in registered inventory. This is where risk builds. If a large number of March contracts remain open after March 2, and if many longs genuinely want physical silver, then the pressure shifts to the shorts, especially those who do not actually have metal backing their positions. These are often referred to as naked shorts, meaning they have sold contracts without holding the physical silver required to deliver. If they are forced to source metal in a tight market, they may have to buy back contracts aggressively, and aggressive buying pushes price higher, so February 26 decides who must exit. February 27 gives control to the shorts. March 2 begins actual delivery. And from that point forward, the real stress in the system becomes visible. The question now becomes simple. How much silver is actually available? That is what we will examine next. Now let's look at the inventory situation, because this is where the real tension begins to appear. A few months ago, CME warehouses held around 170 million ounces of registered silver. Today, that number has dropped to approximately 88 million ounces. In just a short period, inventory has been cut nearly in half. If the current downward trend continues, projections suggest that by March the 2nd, The first delivery day, registered silver could fall closer to 80 million ounces. That number is extremely important. 1 year ago, in March, slightly more than 80 million ounces were delivered. That means if similar demand appears this year, theoretically, nearly all registered silver could be claimed. Now, it is important to clarify something. Even if 80 million ounces are delivered, that does not mean warehouse inventory instantly drops to zero. The metal does not physically disappear overnight. When delivery occurs, ownership changes, not location. The silver remains in the warehouse under a new owner's name. However, the new owner may not leave it there. Industrial users such as automotive manufacturers, solar panel producers, electronics companies, and defense contractors may remove the metal over time for production use. ETFs may move it for storage restructuring. When physical silver leaves the warehouse system, registered inventory declines further. And this is happening while future delivery months are approaching. April is usually a smaller delivery month, but May is typically large. Last year in May, deliveries reached around 75 million ounces. If March already strains inventory, what happens by May? Now let's compare this with open interest. There are currently 47,147 March contracts open. Each contract represents 5,000 ounces. That equals roughly 239 million ounces of silver. Compare that to 88 million ounces in registered inventory. That means open interest represents almost 3 times the available registered silver. Yes, open interest normally falls sharply as first notice day approaches. That is standard behavior. Traders close positions, roll contracts forward, and reduce exposure. But the key question is not whether open interest will fall. The key question is how much it will fall. If the current trend continues, projections suggest around 125 million ounces could still remain open by March 2. That is significantly more than the expected 80 million ounces available. This imbalance creates pressure. If too many longs remain and genuinely want delivery, shorts must either deliver metal or buy back contracts. If physical supply is tight, buying back contracts becomes the easier option. But aggressive buying drives prices upward. In a normal environment, this process remains orderly. In a stressed environment, price volatility increases sharply. The most vulnerable participants are the naked shorts, those without sufficient physical backing. If forced to cover positions rapidly, they may push prices higher in a short period of time. This is how a squeeze forms. It does not start with panic. It starts with imbalance. Then timing pressure increases. Then liquidity tightens. Then price accelerates. The silver market does not need every contract to demand delivery. It only needs a higher than expected percentage to remain open to create stress. And right now, the ratio between open interest and registered inventory suggests the system is tighter than it appears on the surface. So, what is the realistic outcome? The most likely scenario is that open interest continues to decline before and shortly after first notice day. Many traders will close or roll positions. This reduces immediate stress. However, if open interest does not fall enough, if a large number of longs remain committed to taking delivery, then the shorts face increasing pressure. In an extreme scenario, if open interest remains unusually high and physical inventory remains tight, shorts would need to aggressively buy back contracts. That buying would push silver prices sharply higher. This would not be gradual. It could be explosive. The worst-case scenario for shorts, though unlikely, would be a situation where open interest barely falls and delivery demand remains strong. In that case, they would need to source silver beyond readily available supply, or bid up prices until longs are willing to sell. Either outcome results in higher prices, but we must remain balanced. Markets are dynamic. Inventory can shift between eligible and registered categories. Large players can negotiate privately. Price spikes can quickly encourage profit-taking from longs, so while the setup shows potential tension, outcomes depend on participation behavior. The important takeaway is this: the silver market is entering a high sensitivity period. Inventory is lower than previous months. Open interest is elevated. Delivery timing gives control to shorts, but physical supply gives leverage to longs who truly want metal. When paper claims significantly exceed available supply, the system relies on most participants choosing cash settlement over delivery. If that assumption weakens, volatility increases. This is why the final days of February and early March deserve close attention. If you want deeper breakdowns like this, clear, data-focused analysis without noise, make sure you stay connected with Gold Silver Scope. We focus on real numbers, real structure, and real risk inside the gold and silver markets. And remember, this analysis is for educational purposes only. It is not financial advice. Markets involve risk, and every investor should do their own research before making any financial decisions. The next few days could be routine, or they could reveal something much bigger building beneath the surface of the silver market.